Hello, brothers and sisters. A warm welcome to Investigate. I'm Avatar Lahiru, your guide in this series. Nice to see you again. Today, we explore our first substantive topic under Chapter 2, which is on financial markets. When we hear the word market, most of us think of goods being traded like rice, vegetables, or clothes. But there is another type of market where what is traded is not goods, but money, credit, and financial instruments. That is what we call the financial market. So, what do we mean by a financial market? A financial market is the meeting place for those who have excess money and those who need money. It connects savers with borrowers, businesses with investors, and even governments with financial institutions. Without financial markets, money would not flow efficiently, and economic growth would be limited. Now, the financial market in Sri Lanka, like in most countries, can be divided into two main parts: the money market and the capital market. First, let us have a look at the money market and then move on to the capital market. The money market is for short-term funds, usually with a maturity of less than 1 year. Here, we find instruments like treasury bills issued by the government, commercial papers, certificates of deposit, and short-term lending and borrowing between banks. The money market is critical for liquidity management, and it ensures that banks, companies, and the government can cover their short-term needs. In Sri Lanka, the leading issuers in the money market are the government, banks, and listed companies, while the main investors are banks, insurance companies, and pension or provident funds. The interbank foreign exchange market, where currencies are traded between banks, is also closely linked with the money market. Now, let us look at the capital market. The capital market, in contrast, is for long-term funds, more than 1 year. Its purpose is to provide businesses and governments with the capital they need for development, infrastructure, and expansion. The main instruments here are treasury bonds, private debt securities such as bonds and debentures, and equities, better known as company shares. The capital market itself has two major segments. The debt market, also called the fixed income securities market, includes both the government securities market and the private debt securities market. Government securities include treasury bills and bonds, while private companies issue commercial papers, corporate bonds, and debentures. The other segment is the equity market. This is where shares of companies are issued and traded, and it has two levels. The primary market is where new shares are issued for the first time, often through the Colombo Stock Exchange. Companies raise capital here by selling shares directly to investors. The secondary market is where investors trade those shares among themselves after the initial issuance. This is what most people think of when they hear the word stock market. So, in summary, the money market provides short-term financing, while the capital market provides long-term financing. Issuers in these markets include the government, banks, and private companies. Investors include banks, insurance firms, pension and provident funds, and individuals like you and me. And now, why does this all matter to us? Because financial markets are the lifeblood of the economy. They mobilize savings and turn them into productive investments. They provide funds for businesses to expand and governments to build roads, schools, and hospitals. They give investors opportunities to earn returns. And they support economic growth by creating jobs and services. That is why financial markets are so important. They are the platforms where money moves from savers to borrowers, from households to businesses, and to the government. In the next video, we will study about the financial institutions, the organizations that make this entire system work. Thank you for listening. See you in the next video.